Now, with focus essentially shifting to the Strait of Hormuz, where US-Iran clashes have raised fresh concerns over energy flows. At the same time, the Wall Street is responding to what traders are calling the nacho and taco trade setups, reflecting competing bets on how long this volatility will last. At the center of market attention is the Strait of Hormuz, through which roughly one-fifth of global oil supply passes. Renewed military exchanges between the US and Iran have sparked fears of disruption, sending Brent crude sharply higher at points up as much as 3% intraday before easing. Brent is still holding elevated levels, recently settling around the $100 per barrel mark as traders price in the risk of intermittent supply shocks than a full shutdown. A series of unusually timed oil market trades worth nearly $7 billion is now under scrutiny from US regulators and market experts. But beyond the headlines, traders are now openly positioning around what they believe will or will not happen next. One emerging theme is a so-called nacho trade, shorthand among traders for the view that the Strait of Hormuz will not fully reopen to normal stability anytime soon. It reflects growing skepticism that tensions will quickly de-escalate, supporting a persistent risk premium in oil. Alongside that is the taco trade, a market nickname for betting that Trump always chickens out on sustained escalation or aggressive policy moves, a reference to investor expectations that geopolitical pressure or even tariff threats may eventually be softened or reversed. Traders say that this dynamic is contributing to choppy price action as positioning swings between escalation fears and de-escalation hopes. Despite oil volatility, equity markets have remained surprisingly resilient. The S&P and Nasdaq continue to hover near record levels, driven by strength in technology and chip makers, even as energy markets fluctuate. Investors are essentially balancing two trades at once, a risk-driven oil hedge on one side and growth-driven tech rally on the other. Adding to the mix, US jobs data was stronger than expected, reinforcing economic resilience. However, consumer sentiment has dropped to record levels, weighed down by higher fuel prices and cost pressures. That leaves the Federal Reserve in a holding pattern, watching inflation risks tied to energy while avoiding any near-term policy shift.